Whatever you were doing right now, driving to work, hitting the gym, or maybe just staring at the ceiling wondering if you should call in sick, I want you to stop for a second. Look at the date. It is Monday, January 26, 2026.
We are firmly in the mid-20s.
We are. And if you've been watching the terminal this morning or just, doom scrolling financial news on your phone, you know the vibe out there. It's weird. Traditional finance feels creaky is the polite word, right?
Creaky is generous. I'd say strained.
Strained. Yeah, that's it. We are seeing liquidity expanding at a rate that honestly makes the post-COVID era look like a practice run. The money printer isn't just going brrr anymore.
No, it's practically smoking. It's overheating.
Right. And everyone I talked to, from my Uber driver this morning to my actual broker, is asking the exact same question. Is the old 60-40 portfolio finally dead?
It's the question of the decade, isn't it? And the answer, I think, keeps coming back to yes. But not for the reasons people think. It's not because stocks are bad. It's because the bonds, they just aren't doing their job anymore.
They aren't the safety net. They aren't catching you when you fall.
Exactly. With life expectancy pushing into the 90s and currency debasement accelerating, you can't just preserve wealth anymore. That's a trap. That's a losing game.
You're just treading water.
You have to grow it aggressively just to stay in the same place, purchasing power-wise. People aren't looking for returns anymore. They are looking for survival. They're looking for a completely new path to economic freedom. They are looking for fire.
Fire. Financial independence, retire early. It used to be this niche thing, about coupon clipping, living in a van, and reusing tea bags. But now it's about high-level asset management.
It's about being the CEO of your own life.
And that brings us to this stack of papers you dropped on my desk this morning. How to Achieve Fire with Bitcoin, the 2026 Strategy Guide. Now, I'll be honest, when I saw the title, I thought, great, another Bitcoin to the moon hype piece.
I knew you would. I was waiting for that reaction.
Can you blame me? But I started reading it, and it's not that at all, is it?
No, this is pure quant. It's boring, beautiful math. It analyzes data from 2015 all the way through the madness of last year, 2025. It covers tax strategies, specifically for the Korean market context, which is an absolute beast right now, portfolio theory. And it deals with the one thing most reports ignore.
Psychology.
Psychology, the human element.
That's what hooked me. The mission here isn't price prediction. We aren't looking into crystal balls. We are looking at a mathematical strategy to turn volatility, which usually scares people to death, into a tool.
A tool for early retirement. It's about engineering your finances so that the chaos of the market actually works for you, not against you.
Okay, a quick note for everyone watching the video version of this deep dive on YouTube. We're going to be referencing some charts and data tables from the report. I'll do my best to paint the picture for our audio listeners so you can literally see the math in your head. But trust me, the numbers we are about to discuss are, well, they're wild. Let's jump right into segment one, the status of Bitcoin here in 2026.
Let's do it.
So, the report opens with this concept of the digital gold thesis. We've heard this for 10 years, but by now, in 2026, has that argument finally been settled? Or are we still debating if it's magic internet money?
I think the data says the debate is over. I mean, you'll always have the holdouts, but for serious portfolio managers, it's settled. If you look back at the last decade, Bitcoin has cemented itself. It's no longer just this weird, speculative tech play. It's a portfolio diversifier.
But it's a diversifier that can drop 70% in a year. That's a tough pill to swallow.
It is. The report highlights that. It shows these massive drawdowns crashes of 70%, even 80% or more. These periods where everyone, and I mean everyone, said it was going to zero. And yet, despite that, it has outperformed both the S&P 500 and physical gold over the long term.
But it hasn't been a smooth ride. It's been a roller coaster inside a washing machine during an earthquake.
Not at all. And that's actually the point. That volatility is the feature, not the bug. And the report pulls up a key data point that I think we need to highlight because it really explains the current landscape. It calls it the great decoupling of 2025.
Oh, I remember this vividly. I still have PTSD from my portfolio last year. It was such a weird year.
It was bizarre. Let's look at the type. The S&P 500. What did it do? It ground its way up. It wasn't pretty. It wasn't a rocket ship, but it finished the year up 5.0%.
Right. Stocks did their job. Barely. Kept up with inflation, maybe.
Maybe, but Bitcoin. It finished 2025 down 14.4%. And I remember the headlines in December 2025. Bitcoin is dead. The correlation is broken. Go back to gold. Crypto winter forever.
I remember. I think I panic sold a little bit myself, if I'm being honest. But this report argues that this disconnect, this failure to go up with stocks was actually a good thing. How does that even work?
It's the most important thing that happened to portfolio theory in 5 years. Think about it from a fund manager's perspective. What is your absolute worst nightmare?
That everything goes down at the same time. Correlation 1.
Exactly. Correlation of 1. If stocks crash and your hedge or your diversifier crashes right along with them, you're dead in the water. You're not diversified at all.
You just have different flavors of the same risk.
You've got it. You want non-correlation. You want one thing to zig when the other zags.
And 2025 proved that Bitcoin can zig.
Precisely. Even though it zigged down while stocks went up, the mathematical fact that they stopped moving in lockstep is what matters. It means your overall portfolio volatility drops. Your Sharpe ratio, which is basically a fancy way of saying how much return you get for every unit of stress or risk you endure, it actually improved.
That's so counterintuitive. An asset going down made my portfolio safer.
Over the long run, yes, because it proved it's not just holding hands with the NASDAQ and jumping off a cliff together. It has its own drivers. And that brings us to the next point in the report.
What's driving it now, then?
It's become highly sensitive to global liquidity, specifically M2 money supply.
Okay, let's unpack that term M2. I hear it thrown around on CNBC all the time, but what are we actually talking about?
So think of M1 as the cash in your wallet and in your checking account. Very liquid stuff. M2 is all of that, plus savings accounts, money market funds, things that are almost cash. It's basically the total amount of money sloshing around the system.
So it's the global ocean of cash.
A pretty good analogy, yeah. And what we found, what the data shows, is that Bitcoin reacts faster to changes in that ocean level than stocks do. When the Fed cuts rates or injects liquidity, Bitcoin moves first.
It's like the canary in the coal mine for liquidity.
A very volatile but very sensitive canary, yes. It's the first to react. It also acts as a geopolitical hedge in some crises, but, and we have to be honest here, it still suffers from panic selling when things get really scary.
So it's not a perfect safe haven.
It's not. It's this weird hybrid. It's a risk asset and a safe haven wrapped in one, depending on the day of the week and the specific crisis.
Which brings us to the how. If this thing is so volatile, dropping 14% while stocks go up 5%, how do you actually retire on it without having a heart attack? I mean, FIRE is supposed to be about freedom, not checking your phone every 5 minutes in a cold sweat.
Right. And this leads us to segment 2, the core strategy. The report calls it Why DCA Wins, and it brings the receipts with the math. This is my favorite part of the report because it takes emotion out of the equation. And let's be real, emotion is what loses you money.
Okay, let's define terms first for the back of the class. DCA, dollar cost averaging.
It's as simple as it sounds. You invest a fixed amount of money at fixed intervals, regardless of the price. You buy, say, $1,000 worth every month on the 25th. Doesn't matter if Bitcoin is at an all-time high or in the depths of a bear market, you just buy.
And the mechanism here is the cost averaging effect. Walk me through why that's so powerful.
Right. It's simple arithmetic, but it feels like magic. When the price is high, your $1,000 buys fewer units of Bitcoin. But when the price crashes, that same $1,000 buys significantly more units.
So your machine, you're automatically buying more when it's on sale and less when it's expensive.
And you're lowering your average entry price over time without even thinking about it.
The source material has this incredible simulation from 2018 to prove this point. It's a tale to investors. I want to walk through this because it really blew my mind. I want to paint a picture for everyone listening. If you're driving, keep your eyes on the road, but imagine this scenario.
Let's break it down. It's a perfect case study.
Okay, meet investor A. We'll call him Lump Sum Larry. It's late 2017. You remember late 2017? Thanksgiving dinner, everyone talking about crypto.
Total euphoria. Your grandmother was asking you how to buy Ripple. Your dentist was giving you stock tips on something called Tron.
Exactly.
Yeah.
So Larry gets massive FOMO. He's terrified of missing out. He takes $12,000 of his hard-earned savings. Maybe it was for a car, maybe a house deposit, and he buys all at once. He buys at the absolute peak, $19,000 per coin.
The classic top buyer. We've all been there. He feels like an absolute genius for about 3 days.
And then the gravity hits. Fast forward to the end of 2018, the market has completely imploded. Bitcoin is down to around $3,200. Larry's $12,000 portfolio, it's now worth about $2,020. That's an 83% loss.
Just try to imagine that feeling. You open your app and 83% of your money is just gone, vaporized. Psychologically, Larry's destroyed. The data shows that people in Larry's position almost always sell at the bottom.
Why? Why not just hold on?
Because they're terrified it's going to zero. They just want the pain to stop. It's a purely emotional decision to cut the loss.
But even if he had nerves of steel, the report says it took him 3 years until late 2020 just to break even. 3 years of staring at a red screen.
3 years of regret, 3 years of his spouse saying, "I told you so." It's brutal. Now let's look at Investor B. We'll call her DCA Debbie. She also has $12,000 to invest for the year 2018, but she doesn't dump it in at the top. She's methodical. She decides to buy $1,000 every single month throughout 2018.
She's methodical, a robot.
This is where the magic happens. She buys $1,000 worth when the price is $15,000 in January. She buys at $10,000 in March. But here's the key. She keeps buying as it falls to $6,000, then $4,000. And eventually she buys a huge chunk at the bottom at $3,200. She is scooping up massive amounts of Bitcoin at the lowest prices while Larry is crying into his pillow.
So by the end of the year, her average cost isn't $19,000 like Larry. It's somewhere between, what, $7,000 and $8,000?
Exactly. Her average cost is around $7,000 to $8,000. And here's the kicker. As soon as Bitcoin recovers to just $10,000, which is barely half of the previous all-time high, Debbie is already in profit.
Wow.
Larry is still down almost 50% staring at that red screen. But Debbie is already making money.
That is the takeaway right there. DCA isn't about maximizing returns in a straight lineup. If the market only went up, Larry would win. But markets don't do that.
No, they don't. They are chaotic. DCA is about risk control and, more importantly, psychological survival. It removes the need to time the bottom. You don't have to be a genius, you just have to be consistent. It transforms a crash from a disaster into an opportunity to accumulate.
It changes your entire mindset. The report actually gives an actionable tip here that I love. Automate it.
You have to.
Set up the transfer for the day after payday. Don't even look at it.
That's crucial. If you have to manually log in and click buy when the market is crashing 20% in a day and the news is telling you Bitcoin is a scam, you won't do it. Your human brain will scream, "Stop, don't throw good money after bad." You have to remove that human element.
Okay, let's pivot. This is a really interesting part of the report, segment 3. It has a very specific section tailored for the Korean market, but I think the logic applies to anyone living in a high-cost urban center like New York or London or Vancouver. It draws a correlation between Bitcoin and Seoul apartments.
Yes, this is a fascinating insight for Korean investors, but the principle is universal. In Korea, owning a Seoul apartment isn't just about housing. It's the ultimate status symbol, the ultimate safe haven. It's the goal. And the report argues that Bitcoin acts as a psychological proxy for Seoul apartment prices.
How so? Is it just because they are both expensive and seen as scarce?
It's deeper than that. Both are driven by the same macro force. Global liquidity. When money printing ramps up, when that M2 supply we talked about expands, Seoul apartment prices go up and Bitcoin goes up. They are both seen by the public as scarcity assets that cannot be inflated away by the government.
Okay, I see the connection. But there is a huge difference in accessibility, right? I can't buy a doorknob of a Gangnam apartment.
Exactly. And that's the strategic insight. Real estate is illiquid. The barrier to entry is massive. You need hundreds of thousands of dollars just to get in. Bitcoin is liquid and accessible. You can buy $10 worth on your phone in a minute. So the strategy the report suggests is an asset rotation.
Walk us through that. This sounds like some advanced financial maneuvering.
It's actually pretty straightforward. It's about using the characteristics of each asset to your advantage. The idea is to accumulate Bitcoin via DCA during periods of high liquidity, when maybe apartment prices are also spiking and seem completely out of reach. You build your wealth in the liquid, high-velocity asset, Bitcoin.
Okay, so you ride the Bitcoin wave up because it's easier to get on.
Then you wait for the cycle to turn. Eventually, markets rotate. When the real estate market cools off or crashes, which happens much, much slower than crypto, you use your Bitcoin gains, which historically recover faster and harder to buy the real estate.
It's using the volatility of the faster horse to eventually buy the stable farm.
That's a great analogy, and this connects perfectly to the concept of rebalancing, which the report calls the secret sauce.
We talked about DCA as the entry strategy.
Right.
Rebalancing is the profit-taking strategy.
Yeah.
This is the part people are terrible at.
People are terrible at this. It's human nature. They ride an asset up, feel like a genius, and then ride it all the way back down again. The report suggests a strict, rule-based approach. Let's say your target allocation for Bitcoin is, I don't know, 30% of your total net worth.
Okay, let's say 30%. That's my number for this example.
If Bitcoin goes on a massive run like we saw in 2021, and suddenly it makes up 50% of your net worth, you don't just high-five yourself and post your gains online. You sell the excess. You sell that 20% difference to get back to your 30% target.
Ugh, that hurts, though. Selling your winners feels so wrong. It feels like you're leaving money on the table.
It feels wrong, but it's mathematically right. You take that profit and you buy undervalued assets, maybe stocks, maybe bonds, or you put that down payment on that soul apartment. You are forcing yourself to sell high.
And conversely, I assume, if Bitcoin crashes and drops from 30% down to, say, 10% of your portfolio,
You sell some of your stable assets, maybe some bonds that have held their value, and you buy more Bitcoin to get back up to your 30% target. You are forcing yourself to buy low. You are acting like a robot, buying fear and selling greed.
it sounds so simple on paper, but emotionally it's the hardest thing in the world to do. The report suggests doing this on a schedule, right?
Yeah.
Like quarterly or semi-annually.
Yes, or using what's called band rebalancing. You set a band, say plus or minus 5%. If your Bitcoin allocation deviates outside that band, you rebalance. It keeps you honest. It stops you from becoming a bag holder and turns you into a disciplined asset manager.
Speaking of percentages, that's a perfect lead-in to segment 4, allocation sizing. How much is enough? I feel like I see guys on Twitter saying 100% or nothing, but that just seems insane for someone trying to achieve FIRE.
It is insane. It's gambling.
The report breaks this down into what it calls golden ratios based on risk tolerance. Let's go through them.
Okay, they break it down into 3 tiers, and you need to be really honest with yourself about where you fit. First, the conservative tier. This is for the age 50-plus crowd or people already in retirement. The recommendation here is 1% to 3%.
That sounds like the Ray Dalio model, a little sprinkle of something different.
It is. It's just enough to give the portfolio a little return kicker. Maybe boost your annual return by 1 or 2%. But if Bitcoin goes to 0, which is always a possibility, it doesn't ruin your retirement. It's a spice, not the main course.
Okay, next up is the moderate tier.
This is for the FIRE prep crowd, people in their 30s and 40s who have a good job but want to accelerate their path to freedom. The target here is 5% to 10%. This gives you meaningful growth. If Bitcoin doubles, you really feel it in your net worth. But again, a 70% crash won't send you back to living in your parents' basement.
That's a manageable risk. And finally, the aggressive tier.
This is what the report calls the Rick Edelman model, 10% to 40%. This is for the 20s and 30s, or high-income earners who can replace losses quickly. And the argument here is interesting. Because we are living longer into our 90s or even 100s, the old safe investments like bonds simply won't grow fast enough to beat inflation over a 60-year retirement.
So you need that higher growth. You need that rocket fuel.
You need something with a much higher potential return, and you have the time horizon to withstand the volatility. But, and there's a big BUT here, the report has a huge warning in bright red text.
I saw that. What does it say?
It says, never go 50% plus. Never go all in for FIRE. I know the internet loves the YOLO stories, but that is gambling, not investing. The goal of FIRE isn't just to get rich once, it's to stay wealthy.
Right. Getting rich is one thing, staying rich is another.
And if you are 100% in Bitcoin and we hit a 3-year bear market and you lose your job, you are forced to sell Bitcoin at the bottom just to buy groceries. That destroys your wealth permanently. You can never recover from that.
You want to be position size so you can sleep at night. That's the true metric.
Sleep-adjusted returns. That's the most important metric there is. If you're waking up at 3 a.m. to check the price on your phone, you have too much. It's that simple.
I love that. Okay, let's zoom out. Macroeconomics. Segment 5. For years, all we ever heard about was the halving, the 4-year cycle. Every 4 years, the supply of new Bitcoin gets cut in half and the price goes up. But I'm reading this header in the report and it says, the halving is dead.
I know. Blasphemy, right?
It is blasphemy. For the last 15 years, that's been the gospel. You could set your watch to it. And this report is saying,
Yeah.
what? That the 4-year cycle is a myth.
Not a myth, but a relic. It's a historical artifact now, not a future driver.
Explain that.
Yeah.
Because I feel like I'm being gaslit here. This was the whole thesis for so many people.
Look at the supply math. It's very simple. Back in 2016, or even the 2020 halving, the miners were dumping a massive amount of new coins onto the market every single day just to pay their electricity bills. Cutting that constant sell pressure in half was a huge supply shock. It physically moved the market.
Okay, basic supply and demand 101. Less supply, same demand, price goes up.
But look at where we are today, here in 2026. How much of the total Bitcoin supply has already been mined?
The report says just over 94%.
94%. That means the new supply coming from miners is a trickle. It's a tiny garden hose in an ocean of existing supply. If you cut the flow of a garden hose in half, the ocean level doesn't really change.
So the supply shock just isn't shocking anymore. The demand side is what matters now.
Exactly. The report argues we've moved from a supply-side-driven mechanic to a pure demand-side mechanic. We aren't watching miners anymore. We are watching the Fed. We're watching ETF inflows.
So we shouldn't be watching the halving calendar. We should be watching the interest rate decisions and the money printer.
That is the third-order insight here. Bitcoin has graduated. It is now a dependent variable of the macroeconomy. When the Fed prints money and injects liquidity, Bitcoin flies. When they tighten and pull liquidity out, it chokes. It's just like the NASDAQ, but on steroids.
That really changes how you analyze the news cycle. It's less about mining difficulty and more about CPI prints and Fed speeches.
Precisely. You're watching Jerome Powell, not the block reward.
All right, let's get into the weeds, because if you are listening to this in Korea, Segment 6 is probably the reason you downloaded this deep dive. The report has a very specific timeline for the 2026-2027 tax strategy.
This is the most time-sensitive part of the entire discussion. If you are listening to this in January 2026, you are in what the report calls the golden time.
Why golden time?
Because the taxation start date is finally confirmed for January 1st, 2027.
After how many delays? It feels like a decade.
It feels like forever, but it's locked in now, so we have less than 12 months before the rules of the game change completely, and the rules post-2027 are stiff.
Lay them out for us. How bad is it going to be?
It's not great. First, a 22% tax rate on your gains, which includes the local tax. Second, the deduction is only 2.5 million KRW.
Which is nothing. That's about $2,000 US.
It's incredibly low. That's basically a nice dinner for four at a hotel. Everything you make above that is taxed. And third, it's classified as other income.
So it's separate taxation. It doesn't combine with your salary or business income.
Correct. Which is actually good for high earners because it doesn't push you into a higher income tax bracket. But it's bad if you have, say, stock market losses because you can't use those to offset your crypto gains.
So knowing this train is coming down the tracks in 2027, what are the strategic moves for 2026? We have 11 months. The report lists 3 big ones.
Strategy number 1 is absolutely critical. It's the wash sale, or more accurately, the step-up basis mover. This is something you must consider doing at the end of 2026.
How does that work? This sounds like one of those loopholes that gets closed immediately.
It's not a loophole. It's just operating under the current rules. It's a necessity. Currently, there is no tax on crypto gains. So let's say you bought one Bitcoin at $20,000 years ago, and now it's trading at $100,000. You have an $80,000 profit sitting.
On paper. An unrealized gain.
Right. If you just hold that coin past midnight on December 31st, 2026, and you sell it in January 2027, the Korean government looks at your original buy price, the $20,000. You'll pay 22% tax on the whole $80,000 gain.
Ouch. That's a massive tax bill.
But what if you sell your Bitcoin on, say, December 20th, 2026? You realize the profit. Is there any tax you have to pay in 2026?
No, because the law isn't in effect yet.
Exactly. You sell, you take the cash, then 1 minute later you buy the Bitcoin back at the current market price.
So I have the same amount of Bitcoin. Nothing has really changed for me. But what changed on paper?
Your acquisition cost changed. In the government's eyes, you just bought it at the market price of $100,000 in December 2026. You have stepped up your basis. So when you sell it in the future, you only pay tax on the gains made after that December 2026 repurchase.
You legally erase the tax liability on the last 5 years of growth.
Correct. It's a massive one-time opportunity. But the report warns. Watch out for exchange fees and the spread. Don't do it during a volatile crash, or you could lose 1% or 2% on the slippage.
That is huge. A must-do for anyone with large gains. What's strategy number 2?
Corporate investment. As of January 2026, the report notes that corporate investment in crypto is partially allowed. It's about 5% of a company's capital.
Why would someone do that instead of just investing personally?
It comes down to tax rates. The corporate tax rate in Korea is on a sliding scale, roughly 9% to 24% depending on the profit bracket. The individual crypto tax is a flat 22%. If you have a small corporation or you're in a lower corporate tax bracket, it might be more tax efficient to hold and trade the assets in the company name. Plus, you can potentially deduct related expenses.
Interesting. A bit more complex, but could save you a lot. And the third strategy?
Gifting. This is for those thinking about inheritance or passing wealth to family. The valuation for gifting Bitcoin isn't just the price on the day you send it. It's based on the average price of the past 2 months and the future 2 months, a 4-month average in total.
So you can't just pick a flash crash day and gift it then to get a low valuation.
No, the government smooths it out to prevent that. But the strategy is to gift during a crypto winter. If prices have been low and stagnant for months, that's when you transfer the wealth to your kids or your spouse to minimize the gift tax. Don't gift it at the all-time high.
This is high-level stuff. It's not just buy and hold. It's buy, structure, and plan.
That's what FIRE requires. It's a business, and you are the CEO of your own life. You have to think like one.
Okay, let's talk defense. Segment 7. You've made the money. You've planned the taxes. Now, how do you make sure nobody steals it from you? The report is very, very strict on custody.
The rule is simple, and it's the first commandment of crypto. Not your keys, not your coins. If you have FIRE-level money you need to live on for the rest of your life, you cannot, under any circumstances, leave it on an exchange.
We've seen why.
Exchanges go bankrupt. They get hacked. We've seen it happen again and again. FTX, MDocs. The list is long and painful.
So, hardware wallets. The report names names. What are we looking at in 2026 for the best-in-class devices?
The top recommendations are the Ledger Nano X, the Trezor Safe 5, a newer company called OneKey with their Pro model, and the Keystone 3 Pro.
I use a Ledger personally, but I've heard good things about the Keystone. It's air-gapped, right?
It is. It never physically plugs into a computer. You use QR codes to sign transactions, which some people prefer for extreme security. But honestly, the device isn't the most important part. The most important part is how you store your seed phrase.
The 12 or 24 words that can recover your entire wallet.
Yes. And the report explicitly says, do not write this on a piece of paper. Paper burns in a fire. Paper rots in a flood. Ink fades over time. If your house burns down, your life savings are gone forever.
So what's the solution?
Use metal plates. You can buy steel or titanium plates and physically punch your words into them with a hammer and letter stamps. They are fireproof and flood-proof.
And for the love of everything holy, never, ever take a photo of the seed phrase.
Right. Never. No iCloud, no Google Photos, no Evernote, no sending it to yourself in an email. If that phrase touches the internet, even for a second, you must assume it is compromised. Treat it like a nuclear launch code. It's analog only.
Okay, wallet secured. Now let's talk about spending it, the withdrawal problem. This is where the rubber meets the road for retirement.
This is where traditional financial advice completely fails for Bitcoiners. You know the classic 4% rule.
Yeah, of course.
Yeah.
You withdraw 4% of your portfolio every year to live on, and adjusted for inflation, you shouldn't run out of money over 30 years.
That works for a relatively stable portfolio of stocks and bonds. But if you apply that to a portfolio that's heavily weighted to Bitcoin, and Bitcoin drops 50% in your first year of retirement, you have a catastrophic problem.
Sequence of returns risk.
That's the one. It's a portfolio killer. If the price drops 50%, you have to sell twice as much Bitcoin just to generate that same 4% of cash for your living expenses. You deplete your stack way too fast. You dig a hole you can never get out of.
So what's the solution? The 4% rule is out. The report suggests the Guyton-Klinger guardrails.
It sounds super technical, but it's actually very intuitive. Imagine guardrails on a highway. You have a target withdrawal rate, but you have rules that keep you on the road and out of the ditch.
Give me rule 1, the fun one.
Rule 1, the prosperity rule. If your portfolio booms, Bitcoin goes to the moon, and as a result, your withdrawal rate drops 20% below your target. So you have way more money than you need. You give yourself a raise. You increase your spending by 10%.
So you get to enjoy the wins.
You have to. Go on that trip. Buy the nice wine. That's the point of FIRE.
I like that rule. I can get behind that. But there has to be a catch.
There is. You must have Rule 2, the capital preservation rule. If the portfolio crashes and your withdrawal rate jumps 20% above your target, you have to cut spending by 10%. You tighten the belt, you cancel the vacation, you eat at home more.
So you are dynamic. You aren't blindly spending the same amount every year. You breathe with the market.
Exactly. And to make this work, to make it painless, the report advises keeping a cash buffer. This is non-negotiable. Keep 1 to 2 years of your essential living expenses in pure cash or short-term bonds.
So that way if Bitcoin crashes, you don't have to sell it at the bottom.
Precisely. If Bitcoin is down 50%, you don't touch it. You live off the cash buffer for 12, 18, 24 months. By then, historically, Bitcoin has recovered. That buffer is your shield. It prevents you from ever being a forced seller.
This makes so much sense. It takes the fear and the panic out of the crash because you know you have a 2-year runway.
It's freedom from anxiety. That's the real goal.
Let's move to the final segment before we wrap up. Segment 8, psychology. The report breaks down the 14 stages of emotion in a market cycle.
This is the cycle we all go through, whether we admit it or not. It starts with disbelief, then hope, then optimism, belief, thrill, and finally euphoria at the top. And then on the way down, it's anxiety, denial, fear, panic, capitulation, and finally depression at the bottom.
The report has a great insight on how to use these emotions as practical indicators. It mentions the taxi driver indicator.
Yes, the old market adage. When the taxi driver or your barber or your cousin who hates finance starts talking about how rich they're going to get on Bitcoin, that is euphoria. That is stage 14.
And what do you do when you hear that?
You rebalance, you sell, you take some chips off the table, because that's the point of maximum financial risk. The crash is coming.
And the flip side?
When the news headlines say Bitcoin is dead, crypto is a Ponzi scheme, and everyone you know who bought at the top is angry and depressed. That is depression. That is when you DCA. That is when you deploy your capital.
It's basically Warren Buffett's rule. Be greedy when others are fearful, and fearful when others are greedy.
It's that rule applied to a modern asset. But it's so hard to do in practice. Your body, your brain, fights you every step of the way.
The report also mentions the FIRE mindset. It says economic freedom is really just freedom from anxiety.
This is a deep point. If you achieve your FIRE number, but you're still checking the price every hour, you aren't free. You are a slave to the chart. High screen time equals high cortisol. High cortisol leads to bad, impulsive decisions.
The report suggests a digital detox. Maybe check the price once a week or once a month.
And to focus on your BTC quantity, not the USD or KRW price, the mantra is 1 BTC equals 1 BTC. If you focus on accumulating the asset, the fiat price will take care of itself in the long run.
I think that's a perfect transition to our outro. We've covered a ton of ground today.
We really have, from the deep math of DCA to the nitty-gritty of Korean tax law.
Let's try to summarize it. DCA is the engine. It keeps you moving forward regardless of the weather. Rebalancing is the steering wheel. It keeps you on the road and locks in your profits. Security is the seatbelt. It keeps you alive when things go wrong.
And 2026. This is the year to act. This is the year to accumulate before the tax regime changes in 2027. That's the golden time. Don't waste it.
I want to leave you, our listener, with a final thought, something to chew on. We talked a lot about the math and the strategy today, but the report ends with a philosophical question that I think is actually the most important one.
Let's hear it.
The path to economic freedom isn't a straight line. It's about building a system that protects you from yourself. If you have the boat, which is Bitcoin, the compass, which is DCA, and the rudder, which is your principles, you will get there. But ask yourself, once you achieve FIRE and reclaim your time, what will you actually do with your freedom?
That's the real question, isn't it? Freedom is a vacuum. If you don't fill it with purpose, with meaning, with service, it can be just as scary as being broke.
Heavy stuff to end a Monday on, but that's why we do this deep dive. Thank you for listening.
Thanks for having me. It was a great discussion.
Keep stacking, stay safe, and we'll see you in the next one.